Hello, fellow entrepreneurs. I wanted to bring this video to you because I've been thinking a lot about my business lately. And I just feel like my business is another child. It's hopefully my last child. So the question is do you also pour your heart and soul into your business, nurturing it from a tiny idea into a revenue-generating rock star? But what happens if, let's say, you take a permanent vacation to the great boardroom in the sky? Done, just done. Your business is done, and your employees are wandering aimlessly, not knowing what their next position may be. And your legacy goes up in smoke. But no, not on my watch. That's where life insurance riders for business come in, my friend. They're like a secret weapon in your financial arsenal, ready to swoop in and save the day. So today, we'll talk about keeping your business humming, leaving a lasting legacy, and maybe even making a little dough on the side. Yeah, you heard me right, a little dough. So buckle up, entrepreneurs extraordinaire, because this video is going to be a wild ride through life insurance riders and business investments. Hit the subscribe button and let's make sure that your business story has a happy ending, an ending with a sprinkle of superhero flair. Let's get started. So let's go over a few terms. The first one is whole life insurance, and we're going to speak about that first. And whole life insurance has a payout for your beneficiaries upon your death, but it also builds cash value. Riders to life insurance are add-ons that you do pay extra for, but they can enhance the policy and allow you to tailor how you use, especially a whole life policy, as not only protection against the worst thing that could ever happen, but also as an investment. They enhance the functionality for an additional cost. So they're not free, but they are useful. Here are some common whole life insurance riders. Disability waiver. Now, what a disability waiver will do is it will cover the premiums of the life insurance if you became disabled. Basically waiving the premium payments, yet ensuring that your policy stays enforced. Number 2, accelerated death benefit. An accelerated death benefit rider to a life insurance policy allows you to access a portion of the death benefit while you're still living. If you're diagnosed with a terminal illness, it can be used for long-term care from that illness or towards other needs that you may have. Number 3, guaranteed insurability rider. Now, you already have life insurance, so why would a guaranteed insurability rider be useful? Let's say that you purchased a policy when you first started your business and you were young and your business wasn't producing that much revenue yet. So you thought a $100,000 life insurance policy would be perfect. But then your business built, and now your business is worth $10 million. This rider will allow you to purchase that additional insurance for the value of your business without having to go through another medical exam and to show that you're insurable. So it certainly is useful if somewhere down the line, as you're getting older, you end up having just, some sort of health issue that would raise your premium. You don't have to go through the medical. So they're using the medical from your first life insurance application, which can be very useful, especially when it comes down to the cost of adding additional insurance to your policy. Number 4, paid up additional rider. So what's that? As opposed to guaranteed insurable rider. This rider allows you to use the accumulated cash value in your whole life insurance policy to pay for additional insurance. So no money out of your pocket, you're just paying for additional insurance, increasing the death benefit without additional premiums. Pretty good deal. Number 5 is a term conversion rider. So term insurance is life insurance that you pay for a specific amount of years for a specific amount of insurance. It has absolutely no cash value, but it does have the death benefit insurance coverage. So a term conversion rider allows you to convert a portion of your whole life policy to term insurance with level premiums for a set period of time. This may be useful in getting more insurance at a lower cost. It just matters, when you do this and how it's done. So if you wanted to consider that, there are other calculations to work out and to see if that would actually be useful to you and your company. So those 5 are pretty common riders to whole life insurance, but there are additional riders that really play a part in business. So let's go through those. And there's 3. There's a purchase agreement rider, a key person rider, and a loan interest rider. Let's start with the business purchase agreement rider. A business purchase agreement rider is a rider that is used in a buy-sell agreement. So this could be something you put within your business, if you have a partner or partners where they want to buy out your share if you're no longer available. The rider allows your partners to buy out your position within the company and to divvy up the shares. The business purchase rider is a buy-sell agreement between partners. By providing the death benefit to the surviving partners, they then can buy out your share of the business, giving money to your family who supported you in building this business and for their bills and for them to move on. By buying out the deceased partner's share, it takes, let's say, 100%, and you have 4 partners, everybody has 25%. It increases their share of the business, but also keeps the continuity of the business and the business owners to the surviving partners. The second business rider is the key person rider. Now, that would be insurance on someone who may not be a partner, but is certainly a key person and integral part of your business. And this rider provides the death benefit to the business if the key person dies. It is used to offset the cost of, possibly training another employee for that position and other financial losses. It's really to make sure that your business can continue without that person who was key to the daily production and the daily operation of your business. The third important business rider is the loan interest rider. This rider allows you to borrow the policy's cash value and have the loan interest of that loan paid by the policy itself. This can be incredibly useful for business owners who want to expand. They can use this cash value and the loan to expand their reach or put out a new product, because every new launch needs capital, and this could be their secret weapon in finding capital fund this business venture. When considering whole life insurance riders for a business, it does help to speak to someone from the insurance company that you're planning to purchase the policy from, because many insurance companies have different wording to their riders, and you certainly want one, not only insurance company, but riders that are specifically tailored to what you want to do and what you want that insurance policy to do within your business. So take your time with it, because it is a contract between you and the insurance company. So let's talk about life insurance as an asset. Whole life insurance, which can also include variable life insurance and universal life insurance, accumulate cash value over time. So you have your death benefit and you have your cash value. You can typically borrow against the cash value or surrender the policy for cash value. This cash value can be considered an asset. The other powerful thing about life insurance is beneficiary designations and a legacy plan. I know you're not probably thinking of it now, especially if you're a startup, but you're putting in so much work and so much time. You really do need to think about the continuation of your business. I can't even stress how important I think that is. What I like about insurance, and life insurance in particular, is it does offer some lawsuit protections for a business owner. As a general rule, in most states, but again, you have to check this within the state that you live, life insurance proceeds are generally protected against the creditors of the policy owner. If the beneficiary designation is properly made and the policy owner retains no rights to the ownership of the policy. This means if you were personally sued, your creditors could not access the death benefit, because the death benefit is directed towards another beneficiary. There may be exceptions based on your state laws. If this video was at all helpful to you, please like, share, and subscribe. I really would appreciate that. I'm really still trying to build the channel, and every little bit helps. So if you could just hit the subscribe button, I'd really be thankful.